Welcome to TMS Insights, a special edition, as there's been a bit going on in share markets globally that we thought it'd be a good time to bring some news and some updates and some understanding to all of you, our clients. Ben, ASX on Monday, that was yesterday, fell 3.7%, following a 2.1% fall on Friday. Quite a big fall in a couple of days. I think we were talking about a record close for the ASX last Wednesday. So it's amazing how these things are all within 1 week. And we want to let everybody know what the main factors at force are and what's been driving it. But overall, it does mean that the index is now only where it was a couple of months ago. So we've just lost some of the gains. It's been a good period, hasn't it?
Yeah, and I think actually the biggest reason for probably the violentness of the last couple of days has been that we haven't had a correction for so long. It's been, I think I saw a stat this morning that we haven't had a 3% correction in America this year. So,
and to give a bit of context, that you get a 10% correction on average every 2 years over 100 years of data. So it's a really been a lot of low volatility, really.
And 5 to 7% corrections, I would say, a few times a year is pretty normal. So we're in that territory now.
And that's probably why it alarmed people a bit more. And felt it's been a calm that you breathe, basically. And so what we're dealing with here, I think, predominantly are two factors here, Ben. One, we've got to talk about economic data and a turn in the interest rate cycle based on slowing economies, whether that's actually happening. And the second thing is, let's probably try to break down for people what's been going on in Japan, because it's really the most significant thing. We might start with that. So there's something called the yen carry trade. Carry trades have been around forever, nothing brand new, but this one is quite new because last Wednesday the Bank of Japan put up rates for only the second time since 2007 and only up to 0.25%. Okay? And that's basically caused a lot of this, hasn't it?
Yep, it has. Because at the same time, where that carry trade has probably been getting invested, which is into US dollar denominated assets, we have seen a swivel in what rates are likely to do there, where, you know, only it feels like a few weeks ago, there was debate as to whether the Fed had done enough, to now where markets are pricing in 125 basis of rate cuts by the end of this year. So there's been this sudden, very marked change in the interest rate outlooks between those two countries and the movements in the currencies.
Exactly. And all of those things are related. This carry trade, we just pause for a sec to give everybody a bit of that background, because for 2 decades you've been able to borrow cheaply in Japan, virtually at zero rates, and take that money hedged somewhere else in the world and invest it. Bonds, equities, crypto perhaps. And those asset classes have benefited from that carry trade. And Japan has effectively been funding that, or its bank and the markets in the bond market. But as we've seen that minor change, only to 0.25%, the Bank of Japan, and as Ben mentioned, you know, rate expectations in the US have come back, the gap has narrowed. So what's become a 5.5% differential is now looking in forward markets something more like 3.5. The trade still works. It's just not as profitable. It's been an incredibly lucrative trade while it's been going on, but the time for that is perhaps over.
Yeah, and it can just lead to, you know, a small thing. And I think when we've also had no volatility for a long time and markets have been very strong, whether it's crypto, whether it's US tech, whether it's private credit, or money can get ripped out very quickly. The question is how long this lasts for.
And that's that dislocation you can see. I often think, I try to explain it as, imagine if everybody was on one side of the boat and they all moved to the other side of the boat. Well, it's going to be rocky, and that's what happens in markets. It'll stabilise at some point. So how much of it, we're never going to be too precise about that. But this is actually quite a normal activity of when you see this sort of thing happen. Can we then go to looking at that economic news? You touched on it. So there was a piece of data out on Friday. There's data all the time, everybody. So we often say this is the most important piece of data till the next one. But that was non-farm payrolls or employment numbers. Now, they were expecting a number of 175,000 on Friday night US time. It came in at 114,000. To the average person, that doesn't sound much in a population of 320 million people.
Correct.
But for economists, they add up the bits of data and they say, well, I think the US is slowing. the economy's slowing. And if that's the case, how does that look for all asset classes?
Earnings
outlooks will be under pressure potentially for some things. So that caused a retreat then. Now, then, as we said, the next bit of data was overnight. That was Monday night Australian time in the US, was the ISM data showing manufacturing. And that was actually a nice read. It was above the 50%.
beat expectations.
So beat expectations. Yeah. So we may have a jury out situation on the US economy.
Yep.
Is that how you see it?
I think so. As we're going to with rates, the Fed for a while now looked like they had engineered the incredible scenario of taming inflation without causing too much pain to the economy. And if you go back a year or a year and a half when this interest rate hiking cycle started, there was a lot of concerns about a hard landing in America. And I think so that, it's not just what's going on, it's what markets were also expecting. And a week ago, there was no talk about this whatsoever.
No.
And asset prices weren't probably reflecting some uncertainty about what the economy is going to do. And very rapidly, they're trying to price that in.
Yeah.
And so I agree. I think we looked at a piece of research from Goldman, which said they lifted their recession predictor from 10% to 25% on the back of this data.
Yeah.
That still is a 75% chance that there is no recession.
That's
but right. It's just
it's the fine tuning, isn't it?
Yeah.
And this is hard for people to understand, but it produces big results after strong performance. So the reality is it's reflecting on really good outperformance because we know how well the share markets perform over the last year and multiple years. So, the pain can be a bit greater and the dislocation a bit greater. It might be short-lived though, all this volatility.
It could be. It wouldn't surprise me if it is, because I think, if you look at the US earnings that came through, and I would say the other thing that we haven't discussed is we just have gone through the quarterly earnings, and what might have sort of dawned on markets somewhat, I suspect, is that we've had the AI hype for a year now. The megatechs are investing literally hundreds of billions of dollars a year now into AI. And it's probably dawned on the markets a bit that there's a lot of money going out the door, but it's when does the return on the investment
payoff is years down the track, right?
Yeah,
so
they've got to do it because if they don't do it, they'll be destroyed.
Yeah.
But I think there's a bit of that as well.
Sure, near-term earnings outlooks are not probably as rosy as they might be when you're in the investment phase, which is a massive wave of innovation coming. So, really good point. The other thing for everybody is we start hearing of our companies as of this week for their August reporting. And that's our next patch into it, all our clients and everybody, is when we start giving you the updates from this August reporting season, which we'll do twice in August. But really, I suppose to leave it for today's chat, Ben, we obviously encourage people to get in touch if they need to and have a chat about things. But this is the ordinary course of business for us. So,
This is, and I think there's the question ultimately for everyone is, should we be doing anything?
Yeah.
And my advice would be, now is not a time to be going hard into the markets because they've had a bit of a pullback, and you've got to put this in perspective. It is a bit of a pullback. It's also not a time when you should be overly worried about your investments. I think potentially this could be fairly short-lived. So. But ultimately, time will tell. And it's important to stay the course and not try and worry too much when others are worrying, and, not get too carried away in the good times.
Great way to end this session. As I said, we're here for you if you need to call us and have a chat.